This is how I make my money. By recognising trends in the market, by following the crowd, by following the money. Sometimes that's easy. When leadership is obvious and momentum is strong, you simply align with it. But sometimes, like right now, it's really hard. And this is where most fail, by getting into below average trades, trying to fight the trend. Only the strong survive. Only those who sit on their hands and wait. Very few, especially on social media, tell you all this. They mainly use fake charts and fake strategies to show you how easy trading is. It's not. And we need to understand this. We need to remind ourselves how hard it is, even in easy times. Right now, it's about survival. It's not about supercars and holidays in Marbella. This is a stock picker's market. Gone are the days, like only a few weeks ago, where you could buy anything that mentioned AI or signed a deal with Nvidia and expected it to just run to the moon. That phase was momentum driven. Now fundamentals are coming back into focus, and that's why I combine technicals and fundamentals. I want strong companies in strong sectors, businesses that outperform, not just move with the tide. If I'm going to ride the trend, I want it to be supported by earnings, margins, cash flows, and institutional interest. Right now, I need to find stocks showing relative strength to the overall market. And then I wait. I wait for a clear sign, clear technical pattern for me to enter the trade. A proper entry. So what does that look like? Well, I'm looking for higher highs and higher lows. Structure supported by volume. Price holding above the moving averages and respecting them. I personally use the 9, the 21 and the 50 moving averages on different time frames. But you use whatever fits your system and that you have back tested. I colour code mine, so I've got like a bit of a traffic light system, a green, amber and a red. Green tells me that strength is aligned. Amber tells me caution. Red tells me stand aside. There's a lot more that goes into this strategy, but it's a simple framework that protects me from myself. Because most trading mistakes don't come from the market, they come from impatience. And right now, patience is my edge. So we all know that AI has been the clear leader of the market for some time. And now it is cooling. It's not collapsing, it's cooling. Just cooling.
Everybody be cool. You be cool.
And that's an important distinction. When something runs hard, like these AI names have been doing, it eventually reaches a point where expectations outrun reality. Earnings come in strong but not perfect. Valuations get stretched. Momentum traders pile in all late, suffering from FOMO, then price stops accelerating. That doesn't mean the story is dead. It means the market is digesting. Sideways action at the moment in AI is not weakness, it's indecision. And indecision is uncomfortable for traders like me. Trends are easy. Consolidation is hard. This is where we have to sit on our hands and review the situation. Make some what-if statements. What if AI resets, volatility compresses, and we get another leg up? Or maybe what if capital decides to move on? The run has run its course, and now cash rotates elsewhere. That's why I am watching different sectors. I do this by looking at different ETFs. ETFs show where broad capital is flowing. They show what institutions are doing quietly. So what are we seeing right now? Well, many sectors are moving, but should we get involved? Looking at oil services, clearly trending, but it's a commodity-driven, volatile and macro-sensitive sector. Not clean institutional rotation. More reactive than structural, I think, really. Yeah. Regional banks probing higher. That likely reflects stabilisation and reduced fear around deposits. I think that's quite cyclical. Cyclical?
Is that how you say cyclical?
I think that's quite cyclical, not a growth shift. Real estate, ETF strengthening, that suggests bond yields are calming and rate fears are easing. Industrials holding up, that suggests soft landing expectations, not recession panic. Then we've got staples and healthcare quietly stabilising. That suggests defensive positioning creeping in, but nothing is explosive, and that tells you something. The market isn't euphoric, it isn't panicked, it's cautious. This could all change by the time this video gets uploaded, and it usually does. As you can see from the AI ETF, this is the main one everyone's been watching. It's got sideways action. That's key. When the leader goes sideways, the market is waiting. It's waiting for confirmation, waiting for clarity. It's waiting for either join back in, it's safe, or move on, find something else. Is cash rotating aggressively right now? I don't think so. I think cash is nervous. If cash was confident of where it wants to go, you'd see clear breakouts in new sectors. Instead, what we're seeing is probing. Staples and healthcare is one sector that I try and keep an eye on in times like this. These are the main ones I like to watch when cash gets a little bit of fear behind it. Why does money flow there when things are uncertain? In uncertain economic periods, capital rotates towards businesses with predictable cash flows, inelastic demand, stable margins, dividend support. Staples are essentials. They sell essentials. People buy toothpaste and food whether GDP is 3% or 0%. Healthcare is similar. Illnesses do not care where you are in the market cycle. Drug demand, procedures, treatments, all these continue. When growth visibility falls, investors seek earnings stability. It's not about excitement, it's about survivability. That's why staples and healthcare often outperform when recession chatters rise. It's capital preservation behaviour. Right now, we're not surging, but they're quite firm, and that firmness matters. So what does all this tell us about the economy, and would a move into these sectors be justified? Well, the latest data shows that consumer spending is slowing, retail sales are flattening, people are being quite selective with their big purchases. Also, the labour market is cooling, fewer job openings, wage growth slowing, debt creeping higher, delinquencies ticking up. Are we in recession? Many say no, but people are worried. Yes, more than the hard data suggests. Recession odds are elevated, but this is what a transition phase looks like. Growth moderating, inflation cooling, rates potentially peaking, capital cautious. And in these environments, markets don't move cleanly. They rotate, they test, they fake you out. This is where traders struggle. Because when AI was trending hard, it was obvious. You buy strength, you manage risk, you ride it. Now, this is the phase where you sit on your hands and you wait for confirmation. You don't force trades, you watch the sectors, the ETFs, to see where the real money is committing. If AI breaks higher with volume and breadth expands, you join in. If AI rolls over and capital clearly flows into staples and healthcare and industrials, you adapt. As we said, sometimes markets are easy, sometimes they're hard. Right now, I think they're slightly hard. Not because they're crashing, because they are undecided. And when markets are undecided, the edge comes from restraint. So the question we keep asking ourselves is capital confident? Is capital nervous? Right now, I'd say nervous, but not fearful. And until that changes, I'm staying patient. I'm watching those sectors again, and I wait for confirmation and that clean trend to reveal itself. That's how you survive transitional markets. And that's how you position yourself for the next leg, whichever direction or where it comes from. Right now, I'm building watch lists. As always, I'm constantly building watch lists, waiting to preparing for the next stage of the market. Markets are changing all the time, and we need to prepare for that. That's my job. Right now, some of our favourite AI names are taking a hit. Microsoft, Amazon, Meta, Palantir, Google. They've all come under a lot of pressure, mainly because of that capital expenditure that we have talked about in previous videos. I think if AI finds its footing again, these companies are going to boom as capital flows back in. They are the leaders. When the thing comes back, the leaders usually lead again. But here's the key, I'm not emotionally attached to them. If AI makes a comeback, I will be ready. If it doesn't, I don't force it. While those big names are correcting hard, there are others that are quietly holding their ground. That matters for my watch lists, because relative strength in difficult markets, in difficult conditions, tells us something. When the market pulls back and a stock refuses to break down, That's institutional support. That's sponsorship. That's money sitting tight instead of running for the exit. An example I've seen today is TSM, Taiwan Semiconductor. While some of the AI darlings are being sold aggressively, TSM is holding structure far better. That doesn't mean it can't fall. It can. Everything can. But when a sector is under pressure and one name holds up, I pay attention, because when the tide turns, it's often those resilient names that move first. Relative strength during weakness is often the first clue about future leadership, but it's not a guarantee. Let's break it down properly. If TSM is holding up while Microsoft, Amazon, Meta, Palantir and all the other ones are getting hit hard, that tells me something. First, institutions are not rushing to exit. Second, the market sees TSM as structurally important, not just sentiment driven. Third, earnings visibility and positioning in the AI supply chain may be viewed as more durable. Now, historically, what tends to happen when markets correct and then resume a bull trend, the stock that held their structure, respected moving averages, avoided deep drawdowns, are often among the first to break out to new highs. Why? Because they didn't damage their base, and trends build from bases. If TSM pulls back 10-15% while others fall 25-35%, then when risk appetite returns, TSM is going to need less of a recovery back to its all-time highs. That's structurally stronger. This strength gives TSM the edge, but here's the important nuance. Outperformance in the next bull leg depends on what drives that leg. If the next phase is pure AI acceleration and application-led monetization, then hyperscalers like Microsoft and Amazon are going to outperform. If the next phase is infrastructure, chips, manufacturing, then TSM could absolutely lead. Also consider valuation. Stocks that didn't get as stretched during euphoric phases often have more sustainable upside when the next move begins. Sometimes defensive strength during a correction doesn't translate into explosive leadership later. It can simply mean it's less weak, not the next leader. The difference is in how it behaves when the market turns. Does it break out first, expand volume, make new highs quickly, or does it stall while beaten down names rebound harder? That's what we'll watch. That's why we're building watch lists, so we can keep an eye on these things. I'm not saying this as a guarantee that TSM is going to go to the moon and we should trade it, but it's on the list. It's on the list for us to watch and dismiss if we need to. My watch lists are going to be all available on my website. I'm building a website at the moment where you can go completely free and just have a look at what I'm looking at, what I'm involved in, what I'm watching. I'll let you know when it's finished. If it ever gets finished, it's going to get finished. I'm going to do it today. I'm going to be spending the rest of today researching different companies, researching different sectors. I'm looking for companies like TSM that are showing a little bit of something different to what everyone else is showing. I'm looking for companies. Wow. Sorry, I've just seen a massive spike up from AMD. I might make a video on AMD later. Right, already, the market seems to be bouncing back. It's 1:30 and the market is flying upside and the AI stocks are flying up. So everything I've just told you is probably defunct. No, seriously, the message from this video is we're watching with patience. Right now, the market's spiking, but we've got to be careful. Right now, we don't have a green light on the daily chart to get involved. If you want to know more, if you want to get involved in, let's create a community of like-minded people who want to research stocks and support each other through the markets. As you gather, I'm not a natural video maker. I don't sound like you other traders. I'm just a kid from Bradford who started reading some books and now this is how I make my money. It's a very lonely game and I want us all to get involved. I'm looking for the trend. I cannot find a fucking trend.